Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be discussing the subject of timing the market. Now, I've seen this covered on other YouTube channels. I've seen this kind of talked about on the Facebook groups that I'm involved in as far as the stock market goes, and everyone is always trying to say, hey, is this a great time to buy into the market or invest in a specific stock? So in today's video, we're going to be covering buying into an index or the market as a whole, and someone who buys in and times the market, and someone who just buys into the market and they just kind of continue to hold. And they're both starting with $10,000 in this example. They're not adding any more money into their portfolio over the course of this year. And I'm only using a year right now. They kind of just showcase, the examples of these. So the first individual here on the top, he started with $10,000. He invested this $10,000 in June of 2017. During this time frame, the markets went up slightly. So here, anything in the green is where he is currently in the market. Anything in the black during that September time frame here in the black, that's when he took out of the market. He just jumped out because the market took a correction. He said, hey, I don't want this, I don't want to be involved right now. We've been on a bull market for the last 8-10 years. This could be that point where the market's going to have that correction, where it's going to have that pullback and recession. So he jumped out of the market in September of 2017. He took a 0.5% loss, and he patted himself in the back that this could have been a much bigger loss had he not jumped out. Well, the market, it kind of settled off, and as of November, he's like, okay, I stayed out of the market for October. I'm going to go ahead and jump back in. He jumped back in November of 2017. Now, during this 4-month period, November until February of 2018, there was a huge rush. Nearly, the market nearly doubled from an 8% gain to nearly a 16-17% gain. But February 5th of 2018, the markets took a turn. On Monday, it opened up. The markets lost nearly 4 or 5%, and then continued to do so over the course of a week. So within like 1 week, the market lost 10%. This individual, he set limit sells. He sold out of his portfolio. He went from a 15% gain, and he had gained 8% over that course of November until February of 2018. He felt pretty good. It was an 8% return. That's about the average for the S&P 500. He patted himself on the back, and he waited a little bit for the markets to kind of recorrect or readjust and kind of simmer down. And he waited from February until March. There was a little bit of a period right there where it kind of came back up to nearly mid back up between the highs, and he bought back in. During this time, the market again went down in April of 2018 slightly for like a week. There was a little bit of a depression. He sold out again because he's still worried the market might correct even further, back down to those bottoms. So during that time frame, within that 1 day he had joined back in, or a couple of days that he had joined back in, he lost 2% of his, his earnings. So at that point, he had roughly a 5.5% gain over the time that he actually been invested in the market. He waited here just a few weeks and then bought back in of April towards the end of 2018, and has been in the market since from April 2018 until now, June of 2018, and he's accumulated roughly 1.25, nearly 2% gain over that time period from being invested from April until June. Now, this entire period for the year where he'd lost 0.5, gained 8%, lost 2%, gained an additional 1 or 2% during that time frame, that total came out to around 6.6% because he was trying to time the market over that time frame of a year. Now, his initial $10,000 that he had invested is now worth 10,667%. Now, he looks at it. He's made roughly about the return of the S&P 500, that 7 to 10% return, so he feels pretty happy. But if you had been a long-term investor and just put your $10,000 in and just kind of held it in there for the long term, the market would have, you would have been punished in September, you would have been punished in February, but you would have also recovered during those times as well. You would have just stayed in the market. So you would have been punished roughly 10%, gained back 5%, punished 3%, gained back 5% more. So over the long term, this one individual who had just bought into the market in June 2017 and had stayed in the market is now up 14.27% over that same year period. So his portfolio grew from $10,000 to become $11,427 over that 1 year period. Now, both of these examples do not include dividends being paid out to their accounts or having those dividends be reinvested into the accounts, because if you did buy into the S&P 500, they do pay out a dividend every quarter. But I didn't include that in an example. So both of those would have been either slightly higher, because this individual would have been in the market the entire time getting those ex-dividends being paid out. This individual up here may have missed one or two of those ex-dividends and those dividend payments. So that's just an example of someone who's trying to time the market and someone who just went into the market and invested. Now, look at any individual who's investing for the long term. How do the majority of them invest? They invest through their retirement accounts at work, through a 401k, 401b, some sort of Roth 401k account. Now, this account does not try and time the market. Every time you get a paycheck, you get a percentage of your paycheck removed, and it gets moved into the market. Every 2 weeks, every week, how often you are paid, it just continues to buy into the market regardless of whether the market is up or down. So your retirement account invests over the long term, and it averages in every time you get paid. So that seems like it should be one of the better moves to make. You just don't worry what the market's doing. If it dips, that's great. If you're actually keeping track of it, you buy during those dips, because over the long term, what does the market do? It always recovers from any sort of correction or recession over the long term. So if you're 30s, I'm in my 30s right now, so I still have roughly 30 years until I'm looking to officially retire from, the whole game of it all. So I have quite a while to even, not have to worry about the next recession, not have to worry about the next correction, because they take place every 7 to 10 years. So there could be a correction, but at the same time, that's just a better opportunity to buy more shares at a discount and average in over the long term, because $10,000 going into the market on a recession will buy you much more shares than $10,000 buying into a market at the peak. So as long as you average in, you're going to average in at the peak and at the lows, and you're going to have a very good rising, very good movement of your portfolio over the long term, and it's all going to be positive. So I just wanted to make that video covering trying to time the market. And I see a lot of new investors always trying to ask the question, hey, should I get invested right now? I have a friend right now who, he has money in the bank. I keep telling him he should invest a little bit. He keeps saying he's waiting to time the market. He wants to invest after the next correction. Well, the market's been on fire recently. If he had been that one individual who had just put $10,000 into his account, he would have been up, over $1,000, $1,400 over the time frame of just 1 year. Instead, he may have a couple, $10, $20, $30,000 sitting in the bank, accumulating that 0.04% gain that the bank are going to give you, or 0.35%, and maybe a 1.7% in a high yield savings account. So he would have made roughly $170 off his $10,000, or $1,000 had he invested just over the long term over the course of the year. So that is just the video. I kind of want to talk a little bit about trying to time the market or staying in for the long term. So let me know, what do you guys try and do? Do you guys try and time the market, or do you just buy and hold over the long term, such as your retirement account is doing for you? And of course, if you did like the video, remember to like, share this with your friends, and subscribe if you have not yet subscribed. I make all sort of content dealing with the stock market, real estate investments, and just general financial knowledge. So that is basically it. As a friendly disclaimer, I am not a financial advisor or a tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor myself, trying to help others make their money work for them, trying to help them out and provide some help. So that is it. Thank you guys for tuning in. I will see you next time. Have a great day. Bye.